In the world of Indian auto ancillaries, some companies shout, while others simply compound. Welcome to this deep dive on Shriram Pistons and Rings Limited, a silent performer that has delivered steady financial growth, exceptional governance, and a strategic moat. If you're a long-term investor looking for an investing candidate backed by fundamentals, this company might just be what you're searching for. Founded in 1972, Shriram Pistons and Rings Limited, or SPRL, is a leading Indian manufacturer of engine components. Their core segments include pistons and piston rings, engine valves, and R&D and engineering services. Their products cater to a wide range of customers: two-wheelers, three-wheelers, passenger cars, tractors, commercial vehicles, and industrial engines. SPRL's strategic edge lies in a DSIR-certified R&D center, backward integrated manufacturing, strong relationships with major OEMs, and globally recognized quality certifications like IATF 16949 and ISO 14001. Importantly, the company is not resting on its ICE legacy. It's actively entering the EV and hybrid engine component space, ensuring future relevance. From financial year 16 to financial year 25, the company has shown steady compounding. Revenue grew from rupees 1,393 crore, that is Rs 1,393 crore, to rupees 3,550 crore, that is Rs 3,550 crore, which is an 11% CAGR. Operating profit rose from rupees 232 crore, that is Rs 232 crore, to rupees 724 crore, that is Rs 724 crore. Net profit grew from rupees 92 crore, that is Rs 92 crore, to rupees 507 crore, that is Rs 507 crore, a 21% CAGR. Margin improvement has been significant. Operating profit margin climbed from 11% in financial year 20 to 20% in financial year 25. Net profit margins doubled from 7% to 14%. What's impressive is the strength post-COVID. From financial year 22 to financial year 25, revenues jumped 72%, aided by automation, rising exports, and a strong rebound in aftermarket demand. In the last 10 years, cumulative cash from operations was rupees 2,792 crore, that is Rs 792 crore. Free cash flow was rupees 1,229 crore, that is Rs 229 crore, positive in 9 out of 10 years. The cash conversion ratio stood at 1.36 times, which is cash from operations to net profit. Even during high Capex years like financial year 24, at rupees 296 crore, that is Rs 296 crore, and financial year 25 at rupees 415 crore, that is Rs 415 crore, the company maintained a positive free cash flow, a rare feat in capital-intensive sectors. So, SPRL's self-sustainable growth rate, or SSGR, was actually negative during financial years 2021 to 2022. But things have really turned around. The SSGR jumped to 21% in financial year 24, 31% in financial year 25. What this basically means is the company is now able to fund its growth through its own internal accruals, not by taking on more external debt or by diluting equity. When it comes to strategy, SPRL's direction is pretty clear. They're developing engine components that are ready for electric vehicles and hybrids, investing in automation and expanding their capacity, and also growing both their aftermarket and export segments. Now, if we compare SPRL to peers like Endurance, Minda, and Ramkrishna Forgings, SPRL actually stands out with the highest operating profit margin at 20.4% and a net profit margin of 14.3%, even though their revenues are kind of at a mid-level. That's a clear sign of pricing power, strong cost control, and honestly, superior product value, all working together. Governance is really a strong point here. There are no pledged promoter shares and no equity dilution, except for a one-time bonus issue. Related party transactions are done transparently, all at market rates. Promoter remuneration is well within limits, and there are active independent directors and regular disclosures. Plus, SPRL is backed by the Shriram Group, which is known for ethical entrepreneurship. All of this really shows that SPRL reflects clean promoter intent. So, efficiency metrics are actually pretty encouraging here. Fixed asset turnover has improved to about 3.32 times. Inventory turnover, that's up to 8.2 times. Working capital days have come down quite a bit, from 113 in FY 2017 to 99 in FY 2025. Receivables have stayed pretty steady, around 52 to 54 days. All these numbers suggest that SPRL can scale up without needing to increase its asset base or risk in the same proportion. Now, every investment, comes with its own set of risks. For SPRL, there are a few things to keep in mind. The auto sector is cyclical, which could impact demand. There's also some client concentration among large OEMs, and that may pose a risk. Then, there's the technological disruption from the ICE to EV transition. Raw material volatility, especially in steel and aluminum prices, can be a concern. Forex fluctuations and Capex execution risks are there as well. And of course, working capital pressures, even though they're improving. All of these need ongoing monitoring, especially as the industry continues to evolve. So looking ahead, the focus areas are a Capex of over 200 crore rupees for financial years 26 and 27, mainly focused on next-gen components. There's also a push to increase export contribution and deepen aftermarket penetration. For investors, it's important to track whether the operating profit margin stays above 18%, cash flow remains consistent, debt stays below 0.3 times, and of course, that the company's EV-ready strategies are executed on time. Alright, let's review SPRL through Peaceful Investing's checklist. Sustainable growth? Yes, with an 11% sales CAGR. Strong profitability? That's a yes too. Net profit margin at 14%. Clean financials? Yes again. Positive free cash flow and low debt. No major red flags in governance or related party deals. Plus, there's improving efficiency and self-funded growth. So the verdict is pretty clear. SPRL qualifies as a fundamentally sound long-term compounder, really ideal for peaceful investing. Okay, let's quickly sum up the key factors. On the positive side, we have revenue CAGR, strength in aftermarket and exports, margin expansion through automation, and rising return on equity and capital employed. But there are some negatives too, raw material cost pressures and the risk from ICE dependence. Now things to monitor would be EV segment execution, Capex return on investment, and changes in Forex and policy. As for possible scenarios, in the base case, revenue could be around 3,800 crore rupees, that is RS3, 800 crore with a 20% operating margin. In an upside case, it might hit 4,000 crore with a 22% margin. And in a stress case, revenue could drop to 3,200 crore, that is RS3, 200 crore and margins to 16%. Thanks a lot for watching this deep dive into Shriram Pistons. Honestly, one of India's quietest yet most consistent compounders. If you like this format and analysis, do like, share, and subscribe for more peaceful investing videos. And just a quick reminder, this isn't financial advice. Always do your own research or consult a professional.